Okay, so start when you're ready. Hello everyone, welcome to the Economic History online event with our speaker Christian Dinesen. I'm going to pass you straight over to Natacha, who is the chair of this event. Thank you, Natacha.
Hello everyone, and welcome to this very exciting online event. My name is Natacha Postel Vinay, and I'm from the Department of Economic History. I've worked on financial and especially banking history for many years, with a special focus, I should say, on moral hazard, which is one of the reasons why I'm particularly interested in Christian's book. I'm very pleased today to welcome our two panelists, my colleague, Dr. Olivier Accominotti, who is Associate Professor in the department and has specialized in financial history for an even longer time than I have, with a special focus on international financial networks, which will, I'm sure, resonate with some of today's themes. And of course, Christian Dinesen himself, author of Absent Management in Banking, How Banks Fail and Cause Financial Crisis. He's our guest this evening. But before I introduce Christian, I'd like to warmly thank our departmental manager, Tracy Keefe, for organizing the event. And also would like to send warm thanks to Peter Sorenza and Max Schulz from the Economic History Department's Advisory Board, of which Christian himself is a member, which supports the department by encouraging engagement with alumni and friends through events such as this one, providing financial support and developing external networking. The board has a particular focus on supporting our PhD students, and the board has special expertise, let's say, in fundraising for our PhD program and incremental PhD fellowship. Christian and other members are very happy to follow up with anyone who would be interested in learning more about it. Okay, so now I'd like to say just a little bit more about Christian. Christian first encountered the LSE as part of his University of London degree in modern history, economic history and politics in the 1980s. He then embarked on a long career involving insurance, management, consultancy, credit rating agency, and investment banking. During his time running credit research at Bank of America Merrill Lynch, he became a frequent visitor to the LSE campus to recruit students for the investment bank. When the bank he worked for lost $30 billion, the thought came to Christian that nobody would manage that badly. And perhaps the bank was simply not managed at all. Christian then decided to understand if absent management might be a viable concept, and if so, how this had come about historically. He therefore returned to the LSE to read a part-time master's in economic history, like I'm sure many of you do just now, from 2010 to 2012, while still working full-time in the bank. He told me of the wonderful discovery that his brain could still work academically for a couple of hours a day. And this was while the financial world was engulfed by the sovereign crisis that followed the financial crisis of 2008, and together became known as the Great Recession. Reading an MSc became a trigger for Christian, changing his life by setting up for himself with a range of activities, including board positions at two of the largest UK insurance companies, management consultancy, executive coaching, and research of his key interests. Another result of Christian's return to the LSE was that he turned his MSc dissertation into the book being launched here today, absent management in banking. The Financial Times reviewed it in August, calling it uncomfortably radical. So if many of you can turn their MSc dissertations into a book, that would be absolutely fantastic for the department. I strongly encourage this course of events. I should let you know that the event is going to be recorded. And as long as there are no technical difficulties, it will hopefully become a podcast, which should become available in a few days. And finally, you, the audience, we're delighted that you're here today and we'll have a chance to ask questions, which I'm sure you're all looking forward to. So the way that we're going to do this is Christian will have around 20 minutes for his presentation, which will be followed by a discussion with Olivier for about 20 more minutes. So Olivier will speak for about 15 minutes and then Christian will have a chance to respond in the next 5 minutes or so. So in about 40 minutes, we will open it up to the audience. The important thing is that if you would like to submit a question, please look for the Q&A icon at the bottom of the screen. And I will try to pose as many questions as I can. So I'll be sort of selecting the questions. The important thing is that when you do ask a question, please remember to give your name and affiliation. Okay, so I think we should just charge ahead with the panel discussion, and let me first hand over to Christian.
Thank you very much, Natasha, for that kind introduction. And also thank you to Olivier for joining this event and for picking up on the discussion when I finished my talk. And finally, thank you to the LSE, starting, of course, with the indispensable Tracy, but to the Economic History department there that has twice welcomed me in for degrees, but now also very, very kindly has provided a platform for the event that we're going to have today. So for the next 20 minutes, I'm going to try and talk to you about two things: complexity and what I call the producer-manager approach. And it is the combination of these two things, complexity and producer managers, that I think can lead to absent management. In Natasha's introduction, she already told you how this sort of came upon me, and I can still remember walking around the trading floor and hearing the announcement of this $30 billion loss. And it was a pretty astounding thing. You'd kind of been going into work and seeing a huge amount of activity going on, and now there's quite a big loss. And it just didn't seem right that nobody would manage that badly. So this very flippant thought came to me, and it was quite disconcerting. I mean, how is this really possible when you're there and you know the people and you see what's going on? And this was really where the LSE became a sort of almost like a refuge to go back and say, is this just a flippant thought, or is it possible to go back and study and see if I can find an economic history answer to the idea of how did we historically get to absent management. And it is important that I'm not talking about bad management. I've certainly done that, and I think we've all experienced that. I'm talking about absent management. And it all starts with complexity. So I think we're going to start, and problem talking about complexity is you have to do it simply. And I'm sure I will get a bit complex at some stage, but that's not the intention. So I think it is logically to assume that you can make something so complex that it becomes unmanageable. It might take a little bit of humility to admit that. I think we're all seeing a situation at the moment with the current crisis, which is extremely complex. And I think at some times you might find that the concept of absent management is relevant to that situation as well. But when it comes to banks, what happened was that originally banks were pretty simple, but they grew in complexity. Firstly, by adding lines of business, then by adding territories, and then they grew in size. They got bigger, and some of them got very, very much bigger. And some of the growth was extremely fast. So you would think that the more complex an organization was, the more specialist management it would require. But that is not what happened, which we'll come to in a moment. In terms of the growth of line of business, of course, banks originally had two very, very basic functions. They accepted deposits and they made loans. And as you go through history, you can see this being added to by the Medici, who provide bills of exchange for international trade, the Rothschilds, who are really an investment bank, issuing and trading government bonds. But today's banks include conglomerates who provide every possible financial service you can imagine. And it is very interesting, I think, that in the Western world, really only banks remain conglomerates, and some of them are very large conglomerates. And it is a contrasting historical development between banks of industry, that banks remain conglomerates while many industrial operations have returned to their core business. When it comes to growth by geography, I found a very interesting quote from the CEO of Chemical Bank when they merged with manufacturers Hanover Bank in 1991. So what he said was, if it's important for the United States to have large, globally competitive automobile companies, globally competitive chemical companies, globally competitive computer companies, it's important to have large, globally competitive banks as well. The most international bank of all, Citi, grew very rapidly. Before 1960, it had 70 foreign offices. By 1994, it had 3,000 offices in 93 countries. And if you visit the Citi website today, you'll see that it's in 160 countries. And then you had some banks who grew both by line of business, by geography, but really just became very, very large. And the single biggest enabler for this growth was when they listed on the stock exchanges. Because previously, banks had primarily been family-owned or partnerships. And it was the listing on the stock exchange that made it possible to take over other banks and paying by shares. And it may not, seem strange, but before the 1970s, there were really only a few large listed banks. Of course, the Rothschilds never listed. The long-term listed banks were banks like Citi, Chase, Barclays, Deutsche. And then the investment banks gave up their partnerships from the early 1970s to the late 1990s, with Goldman Sachs probably being the last in 1999. A quick example of some of the growth. So Bank One in the US acquired 137 US banks in 25 years. In 2000, JP Morgan and Chase merged in a deal worth $30 billion. Only 4 years later, JP Morgan Chase and Bank One then merged, and the deal was worth $58 billion. Of course, it wasn't just in the US. RBS in the UK became one of the largest banks in the world. 171,000 people, 50 countries, and 10 billion profit in 2007. It would be their last profit for 10 years. We have to spend a little bit of time on regulation. Banking regulation may not be the most enticing topic, but it is extremely important. The US Glass-Steagall Act of 1933 followed the Great Depression. It had a very specific aim. It wanted to separate commercial banks from investment banks to avoid conflicts between them that had become very apparent during the Great Depression. But the unintended consequence was that it simplified management of banks. And I think it was the single most important piece of legislation to make banks less complex, which reduces the possibility of absent management. But a similar development took place with the International Bretton Woods Agreement in 1944, following the Second World War. Again, its aim was to make major currencies stable by linking them to the US dollar, which in turn was linked to gold. Again, an unintended consequence was that it made international bank management much simpler. So it's possible to show from history that banking can be made so simple that there are no crises. And I'm just going to go through 5 roughly similar periods to show this. So in the 30 years before the gold standard, that was in 1880, there were 9 banking crises in Europe and the US. 25 years after the gold standard and pre the First World War, there were 23 crises. In the 30 interwar years, including the Great Depression, which was a really tough time, there were 30 banking crises. But then we have 25 years after Glass-Steagall, after Bretton Woods, there were no banking crises. Of course, in the 50 years since then, the US left the gold standard in 1971. In the UK, we saw the big bank loosening of regulation in 1986. And then finally, the repeal of the Glass-Steagall Act in 1999. In those 50 years, there were 38 banking crises, and we're still counting. So a little series of numbers, 9, 23, 30, 0, and 38. It's a strong indication that regulation can prevent a banking crisis. Because I think that banks will do what they are allowed to do. The Nobel laureate Douglas North said, organizations as purposive entities are designed by their creators to maximize wealth, income, or other objectives defined by the opportunities afforded by the institutional structure of the society. And for banks, that institutional structure is primarily regulation. However, regulation does not cause banking crisis because not all banks fail in a crisis. Banking failure is about management, so let's turn to management. Great complexity plus a producer-manager approach is what I think can cause absent management. One of my very first research discoveries was a business school case study. Business school case studies became a really important part of my work in this area, and I very much recommend them. Although they are not used that much by economic historians, I think they are a fantastic source. In 1974, there was a case study done on a bank called First National City Bank. It was a predecessor of Citi. There was a senior manager, not internal, recruited from the Ford Motor Company, and he gave a speech at the American Bankers Association. What he said was, the fact is that traditionally, banking operations are not really managed at all. I think that is a very interesting early observation of absent management, even though, of course, he didn't use those exact words. It is much more difficult to manage two lines of business than one if you're a producer manager. First of all, you remain a producer manager of the line of business you grew up with, but you also become then a manager of new lines of business. The better a producer you are, the more management you get to do. Very real complexity can be identified when you look at the differences between commercial banks and investment banks. So commercial banks have commercial clients. They can be retail or corporate. They do many, many small transactions and they look for long-term relationships. Investment banks, completely different. They're in the capital market, trading shares, bonds, currency, and derivatives. They do few large transactions, often one by one. Managing both of these activities, the high street branch and the listing of shares on the stock exchange, is very complex. And of course, products also got complex. They were derivative products, structured products, derivative structured products, more complex, and in some cases, unmanageable. We have to just mention incentives a little bit as part of management. And incentives have mainly been about growth. Now, of course, historically, when most banks were family-owned or partnerships, it was pretty simple. You wanted the bank to be there tomorrow. You were a partner or a family owner. But incentives were absolutely transformed by banks listing on stock exchanges. Bonuses became cash or short-term share plans. The large incentives were sometimes so large that the bankers became independently wealthy within a few years. And managing independently wealthy people is very, very difficult and sometimes impossible. But most importantly, the majority of incentives were for production and not for management. And this is one reason why this dual producer-manager approach is so important. If you take Lehman Brothers, by 2008, consideration were given to make the incentives risk-based, but no action was taken. And as a small aside, when partnerships listed and the former partners became managing directors, please don't think that it implied management capability. It did imply very strong production. So let's do some real economic history. I think unmanaged banks made the Great Depression significantly worse. There were no specialist managers, which made the banks very poorly prepared for the Great Depression. Particularly in the US, banks became increasingly complex in the 1920s. The commercial banks who took deposits and made loans now also got involved in capital market transactions. They started underwriting share issues. Previously, only the investment banks had done this. And then they provided margin loans, investments in the stock market. They lent money to their customers so they could invest in the stock market. These were complex expansions in new lines of business. They were unmanaged, and they fueled the 1929 crash. So I don't think the Great Depression was exclusively caused by unmanaged banks, but they made it significantly worse. Alfred Chandler, who I think is the godfather of corporate economic history, wrote, "While the enterprise may have a life of its own, its present health and future growth surely depends on the individuals who guide its activities. They coordinate, appraise, and plan." And this is really, I think, Chandler saying, it is about the managers. And that's why it wasn't the regulation who caused the bank failures. They might allow it, but they don't cause it. In the Great Depression, 1,300 US banks failed, but 19,000 did not fail. Interestingly, Alfred Chandler observed specialist management in chemical companies and car manufacturing in the early 1960s, but in the 1960s, banks were simple, and Chandler didn't mention banks. Let's get a little bit closer to our own time as I come to the end, towards the end of my talk. So I think absent management in banking caused the Great Recession. I think absent management is the single most important reason for the Great Recession. It's a very complex question, and I'm definitely biased. But I don't think it was bad management, because I cannot believe that anybody would manage that badly. So the 2008 financial crisis started as a banking crisis that became a financial crisis that became a sovereign crisis, and it's now referred to as the Great Recessions. There were many examples of absent management. We can mention Northern Rock, first bank run in the UK for 150 years, truly historic. Lehman Brothers, extremely complex, highly incentivized growth machine. And Royal Bank of Scotland, of course, which was run by producer managers who were mainly looking for the next bank to buy. And at some stage, they went too far. And when they tried to buy ABN AMRO in the middle of financial crisis, that was the end of RBS as we knew it. But there were many more unmanaged banks. I've chosen two for a little more detail. Merrill Lynch, because I worked there, and UBS, because I think it's a prime example of asset management that is still with us. In the evening of Sunday, the 14th September 2008, I was anticipating the usual early Monday morning start at Merrill Lynch. It was a good time to have a chat with my wife, because it was quite clear that Bank of America could buy Lehman Brothers or Merrill Lynch, but not both. And if Bank of America bought Lehman Brothers, I would be home pretty early Monday afternoon with the contents of my desk in a paper box. If Bank of America bought Merrill Lynch, I'd probably be home at a normal time. Now, Merrill Lynch was an extremely complex and highly incentivized growth machine. It had become the largest provider of mortgage-backed securities. Now, mortgage loans are an asset. They can be packaged and sold to investors. Tranches of packages can be sold, packaging of packaging can be done, packaging of tranches, and finally packaging of derivatives. And if this makes you feel slightly lightheaded, it's because it's very complex. It was so complex that nobody really understood them. And that was combined with explosive growth, leaving this product line to be unmanaged. So the US housing market turned negative in 2006. Investors were full of mortgage-backed securities, but Merrill Lynch kept packaging loans and tried to sell them to investors. When the most secure tranches could not be sold, Merrill Lynch simply retained them. They had a high credit rating of AAA. There was a low capital required to hold them on the balance sheet. But the credit agencies started downgrading these packages. They couldn't be sold, they couldn't be hedged, they fell in value. Importantly, they were not defaulting, but they were extremely complex. And Merrill Lynch and the thundering herd of brokers was pretty much all about selling. I was there at the time, and I've done a lot of research since then, but when it came to this activity, I could not find any trace of management, just amazing growth. I don't think it was bad management. I think it was absent management. And on Monday, the 15th September, Bank of America bought Merrill Lynch for $50 billion. I stayed the whole day, like a normal day. Lehman Brothers failed that day, as did AIG. Moving on to UBS. UBS was known as a universal bank. It had a one firm strategy. That meant that no one person or company should need to go anywhere else for any banking requirement. It was truly multi-line, truly multinational. That's why it was called universal. In the US housing crisis, UBS had no idea of its overall exposures. So the list of losses was as follows: 6 billion from a specialist asset manager, 19 billion from retaining the same tranches that Merrill Lynch had retained, 6 billion from unsold mortgage packages, and 4 billion from investment of its own capital. That's a total of 38 billion. It had to be added up later because at the time, the bank had no idea. And I think not knowing its total exposure was an example of asset management. UBS had to be rescued by the Swiss government. So many other banks failed, some spectacularly. Iceland, Ireland come to mind. And bank failures caused directly a major financial crisis and several sovereign crises. It hasn't stopped because nothing has really changed regarding complexity and producer managers. So let me give you 3 recent examples. JP Morgan, 2012. A trader nicknamed the London Whale lost $6 billion trading the bank's own capital. The JP Morgan CEO said, "If I'd asked some basic questions earlier, I would have caught it, but I didn't." Danske Bank's money laundering in Estonia came to light in 2017. In 2017, sorry. It was historically large at euro 230 billion. That's about 70% of Denmark's annual GDP at the time. The management said, "We overlooked the suspicious circumstances because we had too little focus on and knowledge about the part of the business and the risks that followed." Really recently, like if you read the Financial Times on Saturday, that's last week, Goldman Sachs agreed a 2.9 billion settlement over its role in One Malaysia development Bihar. And the CEO of Goldman Sachs said that Goldman did not adequately address red flags and scrutinize the representation of certain members of the deal team. I wonder if you'll think about absent management as a concept next time you see a bank has lost billions or even failed. So to conclude, I think complexity can be so great it's unmanageable. And I think great complexity plus a producer-manager approach that is a part-time, non-specialist can lead to absent management. Regulation can prevent bank failure and crisis, but does not cause it. Management, not regulation, is the difference between failure and success. And absent management in banks made the Great Depression much worse. Absent management in banks caused the Great Recession. And nothing has really changed about absent management since the Great Recession. So history tells us, I think, that there's only one remedy to ensure that this does not happen again. Banks must be simplified by regulation to ensure that they are always managed. So thank you very much for your attention, and I'll hand back to Natacha.
Thank you very much, Christian. That was really fascinating. I absolutely love the book, I have to say. And one thing I particularly liked about the book is that it's actually fairly simple. So Christian has a very good point to set across. And that point is that complexity is not a very good thing in the banking world. And he exemplifies this really well in his book because he tries to do away a little bit with unnecessary complexity and tries to get to the point and be very clear in his argument. So I really recommend the book because it's a very enjoyable read and it's extremely well structured and well written. So let me hand over now to Olivier, who will discuss, give a few points of discussion, maybe questions as well to Christian for about 15 minutes. And then Christian will have an opportunity to respond to these questions in the next 5 minutes.
Yes, so I just shared my slides with you. I hope you can see them. right? Good. So, well, good evening, everyone. And first, thank you for being here. Thank you to the department to give me the opportunity to discuss Christian's book. I must say it is a big pleasure for me to be here today, even if it's only virtually. I met Christian in 2011, and that was the year when I joined the LSE faculty and the Department of Economic History. And of course, everything was new for me at that time. I had never taught in the UK, never studied in the UK. But I soon realized that I would have fantastic students. And Christian was one of them. He was following my lectures, my classes in the MSc program. And we often went to Barings for a coffee after the classes. And at that time, I remember it was the height of the Euro crisis. So that gave us a lot of things to discuss and debate about. And these are very good memories. So I'm truly pleased to see that a few years down the road, Christian has continued exploiting what is done in the MSc, using economic history, and that he has actually written a book about financial crisis, adopting an economic history perspective, right? So what I'm gonna do in the discussion is first summarize briefly what I got from Christian's book, what is the main thesis, what is the main argument, and then I will ask him 3 questions to push the discussion a little bit further and beyond the scope of the book, maybe, right? And I hope that will stimulate the discussion that we will have with the audience afterwards, right? But first of all, in a couple of minutes, let me try to summarize the main takeaway of the book in a nutshell, right? So of course, this is quite a dense book, and it covers 600 years of banking failures and financial crises. So you might think it is impossible to put it into a nutshell, but in fact, as Natacha said, one of the big merits of the book is that it presents a very clear thesis, a very clear argument, which you can summarize in a few sentences. So what is the book main thesis? Well, the book argues that banks are not being managed, right? And this is not a new phenomenon. This is a phenomenon that Christian identifies in the 15th century already, in the 19th century again, in the 1930s, and then in the era of financial deregulation and globalization of the post-1970 period, right? So banks are not being managed. So why are banks not being managed? Well, Christian gives 2 main reasons. The first reason, as he explained very clearly, is that banks as institutions have become so complex that they have become unmanageable. And that problem, again, dates back to very far back in time, when the famous Italian merchant banking family, the Medici, found it extremely challenging to manage their institution when it became more complex, when they started doing more complex operations than deposit taking, making loans, and dealing in bills of exchange, and especially when they lent to sovereign governments. And also the book includes a very thoughtful analysis of how the merging of investment banking and commercial banking in the late 1990s has created a significant amount of challenges for bank managers, right? So this is the first reason why banks are not being managed. And the second reason is that according to Christian, there is no reward to being a good manager in banking. And in particular, being a good specialist manager is not gonna give you a big bonus, but also it's not gonna lead you to be esteemed by your peers, right? So in terms of the financial, but also the social incentives. Bankers have no incentive to be good managers, right? So eventually, for these two reasons, banks are not being managed, and this absence of management leads to banking failures and eventually to financial crises, which are extremely costly for society as a whole, right? So that's the argument in a nutshell. And in order to establish this argument, Christian does not simply rely on his own intuition, right? But he actually has a real method, right? So this is not simply Christian giving his thoughts about banking, but he actually went to do research with a methodology and to demonstrate his thesis properly, right? And actually that method borrows from different approaches, from different disciplines. First, he extensively relies on historical case studies, and I think this is one methodological innovation in this book, that you combine economic history and management case studies from the Medici again to the Rothschilds, and then to Lehman Brothers and beyond Lehman Brothers. And also he, of course, relies on his own personal experience in the banking industry. And here, the book sometimes reminded me of other monographs which have been written and published on the anthropology of Wall Street and the culture of bankers, right? So there's one famous book by Karen Ho on the anthropology of Wall Street, which I found similar in certain aspects to that book, when Christian describes the culture of banking, what really motivates bankers, what gives them status. There are some very interesting thoughts there about what brings you prestige and social status in the investment banking business. And this is not being a good manager. This is being able to make very profit-making deals, right? And this is why I think this is really good economic history, financial history here, right? Because economic history by nature is interdisciplinary. It relies on a variety of fields, a variety of methods, of approaches to analyze concrete problems of the real world. And this is exactly what Christian does in this book. And this allows him to present new insights on a very important question, a big question, which is, why are there financial crises, right? So you should read the book. And of course, I could go on and on to describe the merits of that book. But I thought my role in this event would be to go a little bit beyond that and also try to question the main thesis and challenge Christian a little bit in view of starting a stimulating discussion. So what I will do here is ask three main questions on which I would like to hear Christian a little bit more, and on which I think we could have a nice discussion, right? So my first question relates to the phenomenon of absent management, the concept of absent management, which Christian describes in the book, right? And here, one potential issue you might see is with how we can identify the presence or the absence of management, right? So Christian here reviews a large number of episodes of banking failures. And sometimes, I had the impression that the very fact that a bank failed at some point was interpreted as evident that the bank was not being managed in the first place, right? And there is sometimes a risk of circularity here in this way of identifying absent management. So, I checked systematically. There is one episode mentioned in the book where Christian identifies a case of absent management, which did not lead to a bank failure. And that was the merging of NatWest and the RBS. But at the same time, there are no episodes of banking failures, which he does not attribute to an absence of management, right? So in a way, this makes it sometimes difficult to see how we can really identify absent management as the main cause of bank failures, if in the end all bank failures are interpreted as being caused by absent management by definition, right? But also, as he said in his talk, Christian is very clear that absent management is not bad management, right? There is a clear distinction between banks which are not being managed at all and banks which are being poorly managed, right? However, I'm not sure that distinction is always that clear. And there were some episodes which were reviewed there, which I thought corresponded to cases where banks were being managed, but the managers were actually very, very poor. So, one example is the Medici, which is the opening chapter of the book, where Christian describes how the replacement of one manager, Benchi, by another, Sassetti, led the bank to decline and eventually collapse. And, I wanted to question here whether this was really an absence of management, which led to the decline of the Medici, or whether there was a manager, but the new manager who had been appointed was actually not a very good one, right? And going even further, there are many cases where I thought that an alternative possibility was not that banks were not being managed, but that they simply took a very high level of risks. And when you take risks, well, it is more likely that you will fail when a shock comes. But the fact that you fail when a crisis comes does not necessarily mean that you did not manage your risks. It could simply mean that shareholders or investors or bank owners consciously mandated the bank managers to take a high level of risk, right? And if that is the case, then of course the question becomes whether banks take excessive risks, and if so, why? And it could be because they do not fully internalize the costs of their failures, because many of these costs are paid by society and are not paid by themselves. And we are back to the old moral hazard problem that economists love to talk about, which leads to the justification for banking regulation, right? So to what extent can we distinguish between absent management, bad management, or banks simply taking a lot of risks, right? So that would be my first question, right? The second point I was thinking about, now assuming that there is indeed a problem of absent management in banking, if you think about it, it looks like a very big inefficiency. And I kept wondering when reading the book, why such a big inefficiency would last for so long, right? It's not a new problem, as Christian says. It dates back to the 15th century. But the lack of management, if you think about it, is a big inefficiency for banks. So if banks were managed, they could earn much more money, they could avoid big losses, they could avoid failures. And of course, it is difficult to understand why such a big inefficiency would persist for so many centuries, right? And Christian partly addresses this question in the book when he talks about the financial and the social incentives that bankers face. But in a way, you could push the question one step further and ask, well, if that internal incentive structure is so inefficient, why do bank owners, why do shareholders not adopt a different one, right? So why don't they reward their staff differently, right? And finally, very briefly, I was wondering as well whether, and this is really an open question for discussion, whether banks are really special with regard to the problem of absent management, right? And here, I was trying to think about possible parallels with other industries, and something that came to my mind was the technology industry, where it seems to me at least that you also have this model of manager producers, right? What gives you status and esteem and probably bonuses when you work at a company like Google or Facebook is probably not the fact that you know how to manage people correctly, but it's your ability to develop a new successful and smart application, right? So I'm wondering whether you could not draw a parallel here between banking and other industries. And of course, the implications are not the same. The implications of Facebook or Google not being managed properly are not the same as for a bank. But in a way, in the same way as Richard Feld, the CEO of Lehman Brothers, was a successful fixed income trader before becoming a manager. Mark Zuckerberg, who is the CEO of Facebook, was a former geek, and Sundar Pichai, who has been appointed recently as CEO of Google, is well known for his engineering skills and for developing many of the products of Google, but not necessarily for his management skills. So I might be wrong because I do not know these firms very well, but in a way, I'm wondering whether this model that Christian identifies of the manager producer is really specific to banking, or whether we can have parallels with other industries as well. And if yes, which ones, and whether we could extend that analysis to other sectors as well, right? So I'm going to end it here for now, and I'm looking forward to a stimulating discussion with the audience.
Thank you, Olivier. Christian, you're very welcome to try and answer some of Olivier's points in about, if you can, 5 minutes. We're a little bit running out of time, but go ahead.
Thank you both. Thank you, Natasha, but also thank you very much, Olivier, particularly for that extremely succinct nutshell. I wish I could have summarized things as succinctly as you did. Let me try and make a couple of comments to the 3 points you raised, all of which are extremely relevant. And I hope that I have gone some way to answer some of them in the book, but I do think they're very relevant. I've been very happy to be challenged on this idea of absent management, because it is, I think I'm trying to say something new. It was something that surprised me when I started thinking about it. And I have not got so far as to say this is absent, this is bad management, etc. I don't really think we can allow people who run very large banking conglomerates to rely on luck. I just don't think that's acceptable. So I'm going to mainly say what's absent and what's bad. And I think if you go to the Great Recession, there was a really good example of not great management, but it was management, and that was HSBC, because they bought the largest originator of subprime loans in the US. And they very quickly, when the housing market turned, realized that this was a really, really bad idea, and they shut it down. But although HSBC had tried to become an investment bank, they had failed to become an investment bank. And although it is a big bank and now has plenty of complexities to battle with, they actually, at that moment in time in 2008, 2009, they just cut down on everything they were doing in the housing market. It cost them a lot of money, but they were so diversified they could afford it. So it was a bad decision to go into US subprime, but it was not complexity beyond what they could do. So that, I think, was bad management that they rectified, but it was management. But when you saw some of the other examples I mentioned, the complexity was at a level that nobody could have managed it. And one of the things I tried to do in the book is I don't name names. I name the Medici and the Rothschilds, they're long dead. But I don't name names in any of the other banks I talk about, because it's not about people, individuals. It's an institutional failure of banking. So that's really what it is. It's okay to make a mistake and rectify it, and to be able to cope with with things, that's bad. That can be bad management, but you are actually trying to manage. But there are times when all you do is grow, and then there's no management. And that is really the difference. If there's some management, that's fine. It's when there's none. Because of one thing, it's too complex. Number two, people are worried about banking and not about running the business. Why has it persisted so long? Because we let them. You know, we let these banks do this, and we let them lose a massive amount of money, and then, you know, we use our tax money to prop them up, and then we let them do it again. And when the former President Barack Obama wants to split the banks up, he doesn't want to do it to avoid absent management. He wants to do it because he wants to stop them, you know, costing this much money. They send so many lobbyists up that they actually, he can't put Glass-Steagall back in. So they just use so much money that he simply is unable to get Congress to agree this act. So that's why. It's just because banks don't want to change this. This really works for them. And they may, you know, lose a couple of $100 billion every 15, 20 years, but that's okay because we'll prop them up and then they can do it again. I definitely think the last question is the one that I really am grateful for. So the problem is I don't know that much about other industries compared to what I know a little bit about banking and insurance. But I think that the producer-manager challenge exists in a multitude of activities. The obvious ones are places like lawyers, indeed management consultants. I tell you, there's some management consultants who are not very well managed because everybody's out consulting, although everybody has a view of how the management consultancy should be run. But I would raise two other ones. One is the health service. I think for many, many, many years, many hospitals were run by the most senior consultant, the most senior doctor, who was actually a producer in being in the operating theater. And why he, and it was almost always a he, should then also run the hospital, you know, which was very much a secondary activity. And then I'm going to say, Olivier, one of the typical places where you see producer-manager challenges are in academia. You have these brilliant academics who want to teach and want to do research, and then somebody says, oh, could you please run the department or the university? And I think you have massive producer-manager challenges there. The problem is I don't know enough about those institutions, but I do hope that there are people who would pick up the producer-manager approach and see if it's applicable to other, not just industries, but other activities as well. So I'll stop there, Natacha, and very, very happy to let you now see if you can find some questions and carry on with the discussion.
Thank you, Christian. That's, again, really, really interesting. So I think we're going to start with one particular question. Let me just point out first that if you want to, I mean, I've selected a few questions here, but if in the meantime, if while we're discussing these questions, you are still coming up with questions, please feel free to write them in the chat box and I'll have a look at them. Okay, so our first question is from Matthew Howard, a student at Winchester College. And the question is, what role can government regulation play in ensuring that banks are managed effectively and ethically? And this is related, I got quite a few questions related to this one, as I'm sure you expected probably. And another question, for example, that's related to it is by Andreas Dankel from Danske Bank. I do agree that poor incentive structures are an explanatory factor of failures. Is short-termism and inoptimal incentives also too complex to manage, or just poor management in itself? So these two questions are related. Obviously, what can we do about poor incentive structures? Can they be regulated? Do they need to be regulated or just managed, or how?
I think the first, I think I have tried to answer a little bit. In terms of effectiveness, I think you should simply say that banks have proven beyond all reasonable doubt that they are unable to manage their complexity. So to be effective, they have to be less complex, and we have to chop them up. Because we, in the role that most of us have here as taxpayers, and all the students who are on the call will one day be taxpayers, there's no reason why we should be propping up these overly complex organizations. So I think that's on the effectiveness. I have to say, when it comes to the ethics, that is a very difficult question. And there are times when you work in an investment bank, which is an incredibly exciting, stimulating place to work, with some of the smartest, most energetic, and also most fun people I've worked with, in spite of what people might think. The ethics are sometimes a little bit hard to find. And I'm not sure that it is government's role to do that. I think I have to say, though, that to give you one example of really good ethics in investment banking was that in spite of the many bad cases there had been in terms of diversity, both on race and gender, there was a time when I worked there where the teams were incredibly diverse, both from a gender and from a race, religion, and sexual orientation point of view. And one of the reasons for that was that the best talent was so important. I would never have guessed that one of the most ethically correct places and most colorblind places I would work would be an investment bank, but that was my experience at that time. Maybe I was lucky, but I don't know how much government can make bankers be ethical.
Can I just ask a clarification question about the breaking up of the banks? Should we go back to Glass-Steagall? And what do you think of the Volcker rule, for example, in the US?
I mean, the Glass-Steagall was exactly what you should do. And you know, when JP Morgan was split up and one of the Morgans joined up with Mr. Stanley to form Morgan Stanley, that was an incredibly effective thing to do. And JP Morgan was an incredibly productive organization until it built the sort of investment bank that it then built. And, you know, even, you know, for what is probably the best bank manager, and he is a very good bank manager, the CEO of JP Morgan, even he missed $6 billion of missed trading because he didn't ask the right questions. So even for him, did it get a bit complex. So I think that's all you do. You do what we did before because it really, really worked. And the banks don't want it to happen because they think that bigger is better, and financing investment banking with deposits from retail customers is really smart, but it's too dangerous and too complex.
I have another question from Peter Serenza at the LSE. How important was the shift from partnership to public company, joint stock company, I imagine he means, format, in the banking sector for the growth of complexity and asset management? And I guess implied here is something like, should we actually go back to partnerships, and what kind of liability structure should we adopt?
There are very few things that were more important. It didn't mean that there were no family banks or no partnerships where you never saw absent management that didn't go wrong. But the listing of a stock exchange and the ability to use shares to buy other banks was the largest enabler that I could find for the rapid growth. So it was tremendously important for increasing complexity. Where I think the second part was very important was when it comes to incentives. If you are a true partnership and you really do together own the bank, I think your interests are aligned with the long-term success of that bank's, and failure is not that attractive. If you are aligned to the extent that you get some shares and in 3 years they're yours and you can walk out the door, I think that was a very, very major influence for absent management as well. So I think it was, you know, but I do not think we should go back because I think it's unrealistic. I think listing is not in itself something that banks shouldn't be able to do. I just don't think that you should allow large commercial banks that are listed to use their shares to buy investment banks. Okay.
Another question by Seb Newsom. Hope I'm pronouncing this all right. From the LSE Inequalities and Social Science Institute, MSc student. What would you suggest to ameliorate the issues of regulatory capture within the banking industry? tough one.
I'm not, Natacha, I'm going to be absolutely honest. I'm not absolutely sure I understand the question.
Okay. Well, maybe we can. We could ask Sam Newsom, but I think maybe we can then move on to another question. If that's, I imagine that what he means by regulatory capture is something to do with lobbying. If he could confirm this. Is there a way in which we could curb lobbying by banks?
I think if that's the direction of the question, I just wanted to make sure. I think that's a really, really interesting point, because it's pretty amazing what banks can do with their lobbying, as we saw in actually, first of all, obviously getting rid of Glass-Steagall, which happened under President Clinton, and then preventing another Glass-Steagall, which happened under Barack Obama. And it is kind of interesting that these are two of, I think most people would agree, of the more liberal presidents. And they were actually the ones that allowed the banks to have full reign. So it doesn't seem to be the political persuasion of the banks, of the president, that determines this, which I think is, I mean, I know we only talk about two, but it's still, I think, very interesting. You know what? I don't really know. I don't know how one limits banks' ability to lobby, whether one can really do that, whether there's a limit to how much money they can spend on this. I think that is a very interesting question. I think perhaps if we were more transparent about what happened, that would be better. But I don't know how we rein in banks in this respect.
Thank
Very good
you.
question.
So our next question is by Lucas Kaliotis from the MSc in Economic History. He's asking, would Christian agree that his thesis on absent management have similarities with Richard Vague's thesis in his book, Brief History of Doom, where the bad quality of credit is the reason for causing financial crisis? I.e., are you linking up your absent management with an issue of bad quality of credit as opposed to quantity? I'm assuming that's what's implied of credit.
I certainly do think that bad quality of credit is a really, really big risk for banks, probably the most fundamental banking risk there is. But if you identify bad quality of credit, you are at least trying to manage the credit risk. So I think I'm probably a little bit more radical. And I know a book called Brief History of Doom sounds about as radical as it gets. And, you know, it is a very good book. But I think I'm probably sort of saying, well, if only people actually managed their credit risk, if people had understood and managed their credit risk in mortgage-backed securities in the US housing crisis, we would not have been in that mess. But what basically happened was that people, and I was one of them, went to places like MIT and Imperial College and recruited the most advanced modelers we could find, sometimes from biochemistry, for example, asked them to model the US housing crisis. And by this stage, we weren't managing anymore. It was so incredibly complex, we had no idea. And if we'd stayed with the credit risk, I don't think it would have got that bad. So I think there is an alignment, but I'm probably a little bit further along in terms of the radical approach, although I do like the word of doom.
So here's a question from Tim Serenza, so another Serenza, and not spelled the same way, from Zetland Capital. Banks are chasing yield, which requires more exotic products, which in turn are harder for management to understand and control. Is there merit in changing quarterly reporting of banks to the public markets to alleviate this pressure to chase yield? Specifically, should they be allowed to report on a less frequent cycle?
I think that's another very insightful and a very technical question. I am not absolutely sure that it is the reporting cycle that causes banks to chase yields. I think that's what banks do. So I'm not sure it's the reporting cycle that is the problem here. I quite like the fact that banks have to report very frequently. At least it gives us some chance to have a look at it on a relatively frequent basis. I think the problem in Tim's question is really the word exotic. You know, do we think that anybody who ultimately relies on the taxpayers to prop them up should be doing anything that could be termed exotic? And I do think there are other institutions who would not be expected to be supported by the taxpayer who could be focusing on the exotic side. So I think it's really about what the banks do and not how often they report. That's the key issue here. And I'd rather that they spent their time reporting on a fairly frequent basis. Although when you look back at some of the reports in the 2008 cycle, it didn't really help us very much.
Okay, I have here a slightly provocative question from Thomas. I don't know his affiliation. The standalone investment bank model has failed. The standalone commercial banks model has failed. Standalone savings banks have failed. Why is simplicity a recipe for success? And I guess this is related to, you often have people who will say, oh, but look, Bear Stearns failed as well. So, you know, why is it so important to separate investment banking from commercial banking?
I think that's, you know, perfectly fair. I would certainly not argue that as long as everybody's own, you know, separates investment bank and commercial banks, then everything is fine. I think it's important, if we take some like Bear Stearns, to remember that they were not only, I mean, they were certainly just an investment bank, but they were also a massive asset manager. And most of their problems came from their asset management to begin with, before the investment bank got it all wrong as well. So perhaps it needed further, not just to be, you know, not be both a commercial investment bank, but it should not also be an investment bank and an asset manager. And that might be another split one should look at. And I say that particularly because the asset managers that were part of investment banks, and I would particularly mention UBS and Credit Suisse, suffered massive outflows during the Great Recession because people didn't trust the exposure that the asset manager might have to the investment bank, even though they were completely split. I mean, they were legally completely split. So I think I'm not going to agree that the single investment bank model has failed. And I think Morgan Stanley is a really good example of that. Now, they are also an asset manager, but I think they're a really good example of somebody who's not a commercial bank who have done better than most, or less bad than nearly everybody else. Just like I said, you know, in the Great Depression, 19,000 banks did not fail. So I don't think you can say that the single investment bank, the single commercial bank model has failed. But you can say that where you combine it, the chance of failure increases significantly.
Can I jump in here and ask you a question I've been wondering about while reading a book? I think there might be a potential tension between a necessity for simplicity and the necessity for diversification. So in some ways, banks can be more complex, but often if they're more complex, they're more diversified, and vice versa. So if I take the Great Depression, for example, very often unit banking is known for having been a problem in the Great Depression because banks were so small and so they couldn't diversify, and banks that had branches overall had a lesser likelihood of failure. So what would you say to that? And that's actually related to another question I saw here, which is related to the international, like, is it necessarily a bad thing to have branches in other states in the US and even branches abroad?
I think this is, you know, this is a proper complex question, right? And I think what has worked pretty well are pure commercial banks operating in many locations. That has actually worked pretty well. And Bank One was a very, very successful operation before it worked with JP Morgan Chase. And you could say that it's still, you know, part of part of a very successful operation in many ways. So I think it's really when you combine two types of complexities that it gets difficult. I have no problem with diversification as such, and I totally understand why banks would like it. So being in more than one state is absolutely fine. I think the problem is when you are both in many locations and in many lines of business. It's the combination of the two types of diversification. And that is, and where we really saw diversification being so complex that people didn't understand it was in the modeling around mortgage-backed securities. And I remember being in meetings where investors were asking about these packages, about the chance of default. And the answer was, it's so diversified, it can't default. And people invested on that basis. I mean, we think it's crazy now, but many, many, many billions of dollars were invested on that argument.
Very good, thank you. Another question here is from Swami, a visitor to the LSE from the US. Do you think the recent complexity of technology in the 21st century, such as quants, HFT, high frequency trading in stocks and currency, are also increasing systemic risks to banking?
Absolutely. I think that is a massive new complexity. And when you sit on a board of a financial institution, one is spending increasing amount of time discussing all kinds of things related to technology. But we don't have to go to how it's extremely complex today. But if you go back to 1987, you had already enough technology to cause a major Black Monday crash, which was basically because you had something called program trading, which allowed people to automatically buy or sell when prices moved at a certain level. And today we consider it pretty simple. I mean, it's quite easy to understand for those of us with technology today, but in those days, it caused a major stock market crash. And that was technology that was not understood, and certainly for some of the larger banks was unmanaged. So I absolutely agree with the sentiment of that question.
Now, another question related to our previous question from Robert Heath, who's an LSE alumni and did an MSc in economics. Christian has focused on line of business, retail and investment banking. Oh no, sorry, I just realized, sorry, this was, so I already asked this question. So another question from someone at Guildford College, can't find the name just now. Never mind the name. Very sorry for the author of the question.
Richard,
I can't find the name. Is it Richard? Yeah. Would splitting bank offerings, for example, loans, mortgages, credit, etc., into different industries improve the stability of the banking industry, in your opinion?
I think the answer is probably the simplest answer I give. The answer is yes. I think it would improve the stability. Now, what banks will say is, well, if we are a bank who wants to offer this, the more deposits we're allowed to accept, the cheaper we can make this offering. And indeed, the more diversified we are, the cheaper we can make this offering. So banks will tell you that the bigger they are and the more diversified they are, the cheaper a product they can provide. And of course, this was the main argument, I would say, for dismantling the Glass-Steagall Act and for the big bang. So, but I do think that if what you want is stability, then I think splitting the bank offerings is how you achieve it.
Okay, well, very many thanks, Christian. So it's now past 6:15, and so we're going to have to close the discussion here. I'm going to have to leave as the chair, but if you want, and as is often usual in these events, it's possible for remaining people in the audience to stay and have a personal discussion with Christian. Perhaps you could either use the chat or even maybe turn on your microphone. Would you be okay with that, Christian?
Absolutely.
And your video. So I'll leave the floor to you guys. And I'm hoping that you're going to have a very interesting discussion. Very many thanks to Christian and to Olivier for this extremely stimulating event. I really enjoyed it. And I hope that the students will be, or the students and everybody else in the audience will be even more enthusiastic about reading Christian's book, which I really recommend. And by the way, which you can see just here, it was really a fantastic read. So have a great evening, everyone, and have a good time with Christian as well. Perhaps, Christian, you could tell students that you would have maybe another 15 minutes or so.
Yeah,
would that be right? Until 6:30? Okay, great.
Till 6:30 UK time, that's absolutely fine. I can see the chat, so if you want to write the question, I can see it and try and answer it.
Perfect.
Thank you very much, Natasha. That's been great. Thank you.
You're welcome. Have a very nice evening. Bye.